Is direct indexing really only for the super wealthy, or is it something for the masses? You get to decide. So direct indexing, basically what we want to do is for a non-retirement account, for a brokerage account, there are taxes that are assessed on any gains along the way. So what direct indexing does is it tries to create losses over time that can help offset those taxes. So what it does, or how it does that, is basically by owning individual stocks rather than owning a kind of a ETF or a basket of stocks. So what that looks like is normally an index fund is going to go out and it's going to buy, let's say the S&P 500 index, it's going to buy 500 stocks. It's going to buy Home Depot and Lowe's. It's going to buy Coca-Cola, Dr. Pepper. It's going to buy Microsoft and Amazon and Google and Netflix. So all of those companies are represented in a basket of stocks, kind of in one ticker symbol or one symbol called an ETF or an exchange traded fund. And basically that basket is static, so it doesn't change or there's no turnover inside of it. Whereas directing this indexing, you actually would own all 500 stocks in that account. So you're going to own all those Home Depot or Lowe's, Google or Amazon. And basically what that would allow you to do is periodically analytics software would basically go in and sell, and they would sell the losers either on a daily, weekly, monthly, or quarterly basis. So what that means is they would sell Home Depot and buy Lowe's. They would sell Dr. Pepper and buy Coca-Cola. And at the end of the year, you might have a good year. And even that with a good year, you might have 200 or so stocks that are down throughout that year. So you've actually realized losses. You're out of those positions for 30 days and then you get back in. And the cool thing is we can actually track the returns of that overall index, that S&P 500, very closely, still while realizing losses along the way. So the advantage is you get a 1099 at the end of the year and it shows a cumulative loss, even if your investments actually did really well that year. So that is the premise behind direct indexing, is you own the individual stock names rather than having one ticker, one basket of stocks that's kind of all tied together in a bundle. But what that means is, well, if you're realizing those extra losses, two things. One is, well, there's an extra cost to having that. So it's generally direct indexing costs around 35 basis points. So that's 0.35% per year. So if you're starting with $100,000 here, that's about $350 per year that you're paying for this service. So the question becomes, is the tax benefit or the tax savings outweighed by the extra cost that you're paying for that direct indexing service? And it really comes down to tax brackets and how high your tax brackets are. If you're in the higher tax brackets, oftentimes it makes sense to do this, especially if you have more and more money in these non-retirement kind of taxable type accounts. So this is something that really used to have high minimums, like $1 million+ to be able to kind of get and own all these stocks. Today, the minimum is about $100,000. So you can get a direct indexing portfolio for relatively not much money. And at the end of the year, you'll get a 1099. Oftentimes it has a loss, even if you might have made money in that investment, which is a pretty cool tax efficient strategy to look at. So this is something you want to pay attention to taxes. Are you comfortable having 500 positions in an account? And are you comfortable paying the extra costs associated with direct indexing? I think it's for the masses. I think this is something that folks with brokerage account, non-retirement accounts can really take advantage of if they're in those higher tax brackets.